Rich people use debt to multiply returns on their capital through low-interest loans and expanding their control of assets. With a big enough credit line, their capital and assets are just securing loans to be used in investing and business. Generating income from debt involves taking out a loan and using the borrowed funds to invest in an income-producing asset. This could include buying bonds, investing in stocks, or purchasing real estate. The income generated from this investment can then be used to pay off the debt. Although the expenses and risks associated with borrowing money are well known, the advantages of doing so are sometimes overlooked. If done responsibly, borrowing money may be a useful tool in accomplishing one's financial objectives, as is the case with well-off individuals. So in this video, we are going to discuss, why do billionaires borrow money more than poor? The video is going to be amazing. Make sure to stick till the end. Now, before we get into this video, make sure to hit that subscribe button and leave a comment below saying I subscribed. I will try my best to reply to as many comments as possible. Rich people borrow a lot, but they tend to use credit strategically. According to the Federal Reserve, there are a few primary reasons why rich people tend to borrow more than lower earners. The first big reason is because wealthier people, in general, tend to have much higher mortgage debt than those with lower incomes. And since they are in a better position to get approved for mortgage loans, they are more likely to own a home. Lower income people who can't afford to buy a house or who can't get approved for a mortgage won't have mortgage debt. Wealthy people also tend to take out larger mortgages and to purchase bigger houses. That's because they can take advantage of the mortgage interest deduction, which essentially subsidizes their home purchase since the government covers some of their interest cost through tax savings. While the deduction is available to lower income people as well, you have to itemize in order to get it, and a large standard deduction often means that itemizing doesn't make sense unless you're wealthy and have lots of individual deductions to claim. Taking out mortgages tends to benefit wealthy Americans because owning a home helps them to build their net worth. They acquire equity in their homes as they pay down their mortgage, and their wealth grows when property goes up in value. The top 1% of Americans also hold 2.1% of consumer credit, which includes credit card debt. However, while wealthy Americans often charge a lot on their cards to earn rewards, they're also likely to pay off their balances in full before they owe credit card interest. Although these balances are paid off, they still show up in the total outstanding credit that wealthy people have, since sometimes card companies report a balance before it's been fully paid. The data shows that while rich Americans are borrowing a lot, they're doing so in strategic ways and using debt as a tool. The borrowing they are doing tends to earn them a tax deduction, in the case of a mortgage and credit card rewards, and they aren't paying a lot in interest because they pay off their card balances in full and because mortgages tend to have low rates. In the case of a mortgage, they're also taking out a loan to buy an asset that will typically grow their net worth. For example, very rich people might borrow money to acquire a company if they think they can improve its profitability. They might also borrow to fund a startup business or use margin in their brokerage account to invest in more assets that will help them build wealth. The good news is most people can borrow like a rich person. The key is to use debt as a tool to strategically improve your personal finances, rather than relying on high-interest consumer loans to cover expenses or unnecessary purchases. While this can be easier said than done, it's possible for people to achieve this by living on a budget and looking into the types of mortgages that are affordable and easy to qualify for. Number 1. Billionaires don't actually have billions in checking accounts. Contrary to depictions in popular Hollywood movies, millionaires and billionaires don't really have tons of money sitting around the house or in a checking account. In fact, billionaires' money is tied up into different asset classes, such as real estate, stocks, mutual funds, retirement accounts, and crypto assets. In other words, billionaires rarely have cash on hand. So, when they need money to invest in new opportunities, the rich leverage their assets to borrow funds. This money is then put into other assets that generate more income, making the rich even rich. After all, investing in appreciating assets is how billionaires are made. Number 2. Loans are cheap. Those who already have assets and high income are seen as less risky borrowers. Wealthy loan applicants are less likely to default on the loan, and even if they do, banks have various options to collect the debt, prompting lenders to offer better terms and lower interest rates. What's more, the rich tend to take out bigger secured loans, which also lowers interest. Low-income earners typically apply for car title and payday loans. These are unsecured loans that offer lower amounts and high interest. On the other hand, the wealthy take out mortgages, which incur much lower interest rates. Zero-interest loans are loans that do not charge interest for a limited time. These loans may come with fees attached, but 0% interest makes them hard to beat. If you can pay off your balance within the zero-interest period, this could be the cheapest option. However, availability and credit requirements are critical factors to consider. Credit cards with promotional 0% APR offers can be another option for low-interest loans. These loans may come with fees attached, but 0% interest, for a limited time, at least, makes them hard to beat. If you can pay off your balance within the zero-interest period, this could be the cheapest option. However, availability and credit requirements are critical factors to consider. In addition to mortgages, the rich can use their other assets to access a form of financing known as a securities-based line of credit. These loans have very low interest rates, easy approval processes, and can be taken out against any non-retirement asset. Thirdly, borrowers can deduct mortgage interest on their tax return, making the loan even cheaper in the long run through tax savings. There is an abundance of lenders available willing to offer better terms just to stay ahead of the competition. By comparing lenders and loan offers, the rich can borrow money strategically and at lower costs. Number 3. Avoid capital gains tax. So why do billionaires borrow against their stock instead of selling it? The short answer is to avoid capital gains tax, which is payable only when you dispose of an asset. Most of the rich people's wealth often comes from the appreciation of assets rather than through regular salary, allowances, and bonuses. In contrast to steady income, appreciation is not subject to taxation until you make a profit from selling an asset that has increased in value. By taking out loans, millionaires get to keep their assets and thus avoid paying a substantial amount in taxes. The buy, borrow, die strategy. This is a common method the uber-wealthy use to minimize the amount of tax payable. The strategy is very simple and consists of 3 steps. Buy. Use your money to buy appreciating assets. Borrow. Use your assets as leverage to get a loan, whether mortgage or SB lock. Die. The beneficiaries of your estate can sell some of the assets to cover any outstanding loans without paying capital gains tax, thanks to the step-up in cost basis loophole. They can then choose to sell off the remaining assets or hold them and, depending on the investment product in question, earn passive income. Number 4. Keep their money. Instead of investing their own money and tying up their funds in various assets, the rich borrow. This way, they also free up cash flow for unexpected or unplanned events. And since loans are cheaper for the wealthy, this comes out as a win-win. For instance, if a millionaire wants to buy a $900,000 house, they will apply for financing and pay less over the life of the loan than they would if they sold their assets. This strategy also leaves their money free to invest in other products and thereby increases their net worth. The wealthy take out loans and have consumer debt just like the rest of us. The difference is how the rich use debt to get richer. Rather than cheating the system, high earners are borrowing and investing strategically in order to keep their assets intact and minimize what they owe in taxes. They also enjoy lower interest rates, so loans are much more affordable. Suppose you want to borrow the same way the rich do. In that case, you will need to avoid payday and installment loans. In general, avoid loans with incredibly high interest rates and borrow for investments rather than for consumption. This means using credit cards only to reap the rewards and the interest-free period, and focusing more on putting your money into appreciating assets. Let us know your opinion in the comments section below. This was all for today. Hope you liked the video. Subscribe to our channel and stay tuned for more interesting videos. Stay safe, and we will be back soon with another video.